Uh, Good evening, good afternoon, good morning, everybody. Thank you for taking the time to join our webinar. I think we've got a very interesting topic today that we'd like to get through, so I appreciate everybody. We do have a small issue. We're waiting for one of our panelists to join, so at any point in time, we should be seeing a few more people joining the panel. But in the interim, I think we've got a really good topic today. I think we haven't discussed with the panelists before. It's a really interesting topic to go through. Again, as a small disclaimer, not all of us, none of us are technology people, but we do kind of run the business. And as we've seen over the past sort of 2-3 decades, how technology is playing a larger impact on how we consume liquidity, how we get priced on that liquidity through a multitude of different reasons. So, yeah. So without further ado, I'm going to introduce Ralston first. Ralston from Velocity Clearing. Hey, Ralston. How you doing?
I'm great.
Yeah.
Thank you, Malcolm, for having me here today.
Yeah, perfect. For those of you who don't know Ralston or from Velocity Clearing, so thank you for taking the time to join us. I know it's early where you are, and we always tend to talk in the morning, so appreciate taking the time. I don't know if you want to just give us a quick introduction, who you are, and a little bit about Velocity will be good to add some context.
Yeah, that'd be great. So Ralston Roberts. I was thinking about this last night as I was trying to just come up with what I was going to say about myself. So I've been in the business, let's just say over 20 years, and lived through a variety of different major market structure shifts. I started my career, working out in California in the boutique firms, mostly technology roles, liaising between our traders and our technologists as we were building new systems. I then moved on to work for a very large software company where I was designing and implementing order management systems, routers, market data solutions, networks, building out new businesses related to execution and so forth, and then moved on and left the United States and moved to London and went to work for a tier 1 firm, co-heading execution services, and again living through a major market structure shift there, which was MiFID II, and then continued on my path, my journey, and went to work for one of the founders of electronic trading, Instinet, where I was running the global firm for a handful of years, which was a tremendous experience, and again lived through a variety of different market structural changes during that tenure, and then to where I am now, which is running markets over at Velocity Clearing, which is a relatively new firm in the space, and I like to refer to us as a technology-enabled full-service clearing firm that specialize in custom workflows for our clients, a robust stock loan business, specializing in the hard to borrows, and a fairly sophisticated execution stack for U.S. equities and options.
Oh, perfect. Well, thanks for that. I mean, I think that's a great intro. And again, I think looking at our ages, I think you and I both have got some stories around what it was kind of like when we first started off in financial markets, and it's probably a good place for us to start. I mean, I think we've seen the ever changing. I mean, I started in financial markets probably early 2000s myself, out of South Africa on an OTC FX desk, where we were still kind of predominantly run by voice brokers. There was still, and I made mention of this earlier, that we still used to send fax confirmations, right, for swap agreements, and kind of, at some point in time, there'd be a queue of 3 or 4 people at the fax machine trying to send off swap confirmations and agreements and things like that. And obviously the landscape has changed. So, I think one of the things, technology is the way it impacts the way we do business. It's a very interesting dynamic, because at the time it all seems like big changes taking place, but sort of proper integrated technology, proper integrated changes almost have that seamless kind of movement once you get over that initial sort of adoption stage and learning the new systems. I mean, as human beings, we tend to be a little bit more resistant to change. So as I reflect on like what I look at what our trading floor looked like on day one to what it looked like when I left sort of 10, 12 years ago, and the adoption of that technology. And I don't know if you may be interested to maybe talk us through what it was like sort of on day one. And I think one of the key aspects is the sort of standardization of data, making it a lot easier, as we become more and more interconnected in these markets, and the way we standardize, the way we speak to each other, particularly exchange traded. So maybe just take us through that journey.
Yeah, I mean, I think I was chatting with some of our interns about kind of the history of things, and you start to realize that that you're dating yourself a little bit, but going back to 2000 or late 90s, and I was in the US and predominantly equities focused at that time, and we were having the .com craze, right? So the big rush of all of the internet stocks and all those types of things. And I worked for one of the firms that was kind of the leader in the IPO market in that space. And so fairly large desk, extremely active from a trading perspective, and covered both listed NYSE names as well as NASDAQ names. And so we had two kind of sections of the desk. And my job at that time was this kind of, I call it like a liaison between technology and the traders. And the reason for the role was that we were going through fundamental changes in how the business operated. And if you remember, everything was very voice driven, very manual, very verbal. And the way that markets were made at that time was kind of, I wouldn't call it best efforts, but it was more of a negotiation and less automatic, right? And so at that period of time, things went from that mode to full automatic. We then saw decimalization come through, which changed like the spreads in all the names and changed the liquidity profiles, changed how things operated. And shortly after that, we saw fee-based trading. All while at that same time, we were transforming the business from this kind of verbal, I believe it or not, paper tickets mode to full electronic. And so this is kind of the rise of the fixed networks, all of the business kind of changing. And it was kind of a scary time. And I remember the learning curve was fairly drastic for kind of getting people that had done something a single way for 20 years to now think about it differently. And I think people could get their arms around with kind of electronifying like order entry and things like that. But I think the trading side of things and moving, to a fully automated market, and then moving to this, what they called fee-based trading. And so if you think about it, what that meant was it's like they called it agency lookalike, or kind of like I buy a share, I allocate a share, and it really changed kind of how things were working, which and from a systems perspective was very complicated. And so I think like that was a really interesting time, and the liquidity profiles and how we traded and all that kind of stuff changed. And Malcolm, I don't know how far you want me to go. That's fast forward the clock even forward.
I wouldn't want to go to. I wouldn't want to go. I mean, I think for us, I mean, again, coming from a more sort of OTC background on the FX side, I mean, again, we were also working with traders who, chatting to their voice broker 5 days a week, 10 hours a day, where inevitably those relationships were formed, where in often these cases, these voice brokers were best men at some of these traders' weddings, and vice versa, right? These were the relationships that we kind of had, and there was a kind of your voice is your bond, and you committed to that, and you kind of stood by your word. But as regulations have picked up, I think once we saw the first introduction of MTFs, multilateral trading platforms, things like that, there was this talk about the muscle memory of sort of old traders and old ways. This is the way we've done it before, and this is going to ruin everything. But as the technology is kind of brought on, and you touch on points around this sort of standardization. Oh, there we go.
Hi, sorry.
Hi, Rog. Sorry. No worries.
A few issues joining in as well. I've solved it now. So
okay,
hi,
no worries. Hi, Rog. Thank you. Thanks for joining. I know you had some technical difficulties, so apologies.
Yes, no problem.
Hopefully we got that all sorted.
Yes.
We're just touching base on. I'll give you a second, but just give you a little bit of context. We're just touching base on what it was like in the days. I mean, we're all of a certain age right now, and we kind of remember what trading floors were back then. But before we get to that, I'll maybe just hand back over to you and maybe just do a quick intro, who you are, talk us a little bit about Mirae. I know you've got a fairly sort of big setup there. So if you just want to give us a quick introduction on that, that would be great.
Yeah, sure. So I joined about 6 months ago as the co-head of Securities Finance at Delta One at Mirae. So obviously Mirae London is very much a part of the Mirae Capital Markets division. So if you look at Mirae as a holistic group, you've got Mirae Holdings on top, you've got the asset manager, and then you've got the capital markets. The capital markets is across across the globe: Singapore, Hong Kong, London, New York, and the London guys are actually our unit is the youngest unit in terms of sales and trading. We've primarily been an IB division, sort of doing like aviation finance and other sort of like deals with the HQ. But since about a year and a half ago, there's been a lot of focus on building the sales and trading division, which then has led to creation of a securities finance division, a fixed income trading division, and we also bought a ETF market maker in London called GHCO, the third largest European ETF market maker. It goes well with our Global X franchise, which is one of the largest ETF asset managers. So we've been brought in to cover existing client base, which is internal, but also to grow the external client base, initially through a counterparty relationship in terms of purely facing the street, but eventually the 2026 plan is very much having a European prime setup, which we are working on to achieve.
Oh, perfect. Well, thanks for that intro, Rog. I appreciate it. And again, apologies for the technical difficulties. Glad you could join it. I think Ralston and I we talking about technology and how talking about the last time we sent a fax, the movement from sort of voice broking, and you remember the old turret boxes and squawk boxes that were set up. So I don't know if you just want to maybe take us through just a quick journey. I think some of us shared some anecdotally about, when I walked in on the floor, we had to write out paper tickets. We could still remember the old dot matrix printers that used to print with those massive pieces of paper. And maybe just paint a picture for us. I mean, what it was like for you in the kind of early days of your career. And then we want to draw the picture of what technology looks like today and what we think it's going to look like in the future.
So I think one of the biggest sort of things for me, obviously, is I joined the Lehman Brothers trading floor in London. Which was a extremely busy trading floor when I joined it. I joined 2007, so it was not only was it busy, it was it was busy for all the wrong reasons, unfortunately, by that time. So even like when you look at your desktop setup, like if you physically look at it, it has changed immensely. You have these massive bulky phones that people used to love slamming, and to a far more sleek.
You could break the desk with the phone, right? When you
exactly
the phone down, you broke the desk, not the phone, right?
Exactly. And now I don't even have a phone now. I just have a thing with a sort of modern sort of call center sort of
headsets,
But so physically that I used to have around when I first started I only had 4 screens, but by the time I sort of left Nomura, I had like about 7 screens, all individual sort of square boxes in front of me, and now I have 2, and they're massive, but they are like sort of curved and like so just physically, just sort of like if you look at the trading desk, it's become quieter because people are actually making less phone calls. People are talking on Bloomberg. There's a lot of all queue going on, so it's a very different experience for someone who, if you walk into a trading floor in 2007, if you walk into a trading floor right now, it's in a weird way, I think the buzz was very good. I think you learned a lot from the buzz. I think there was a sense of sort of you sort of felt where you were, and that kind of had a bit of a I think a bit of an impact on a lot of, at least on me, to kind of energize me in the way it did. But the point is that the people who are coming in now, they haven't known that. So it's difficult for me to gauge whether that's a good or a bad thing. For them, they don't know it, so therefore,
correct, yeah.
Because remember, we are the generation that we've seen phones go from like your Nokia 3110 to a flip phone where a screen, it's we've seen it all, right? So.
Correct. Yeah, we've seen the flip screen. I mean, it's an interesting point you make around the voice brokers and how quiet the rooms are now. I mean, one of the first things I kind of came in was when we were taught is you'd have the brokers just shouting the prices through the boxes. But it was the language. How loud were they? Are you sensing urgency in their voice, right? And that would always kind of give it a little bit of market color. We have technical analysis tools now. We've got sort of depth of book, things like that. None of that stuff was there before. You kind of had top of book pricing, and that was it, right? You have to listen to the voice broker. Is he really looking, or is it just one of those quiet afternoons? So it's a very interesting point on that. And again, I think maybe on that point, I'm just going to switch across. And again, a lot of technology, it helps us the way we do business. But a lot of this is driven by regulation. It's not a point that we like to but it's a necessary piece that we do. So, and I think maybe Ralston, I'm going to hand over to you. But I mean, we've seen the ability or the need to screen transactions, market surveillance, transaction surveillance, KYC screening, and customers. I mean, how much of a part does that play in the overall business on your side? I mean, these are sort of non-negotiable factors, right? These are kind of come down from the top, and you kind of, whether you want to or not, and you made mention of MiFID and.
Yeah, I mean, I think there's market regulations that have come into play that have dramatically changed the landscape from a liquidity perspective, and Reg NMS, MiFID II are probably the two most recent major changes in how the world kind of thought about trading. And off the back of that, there was the rise of new sources of liquidity and new ways of accessing liquidity. All kind of like leaning on technology to enable that to happen. All at the same time, there's this compliance, call it the backstory or pushing behind the scenes compliance, and so there's the trading market regs and how we behave in the marketplace, and then there's the post-trade or the compliance layer behind it, which has gotten overly complicated and way more involved than it ever has been. And so if you think about transaction reporting in Europe and you think about CAT reporting in the US, the level of information that the regulators now have around the transactions, who's conducting those transactions, and their ability to kind of see through what's going on is greater than it's ever been. And why is that relevant, or why is that important? Back to your earlier question about KYC and know your customer, like the ability to put the pieces together is much easier. And so you have to be that much more diligent in your processes around, the clients that you're working with and the business that you're conducting. And it's just a whole nother layer of transparency that never really existed to the level that it does today.
Yeah, I mean, it's an interesting point. I mean, when I was going through some of the stats over the last week and looking at the overall rise of sort of trading volumes over the last decades, I think we saw a sort of 550 or 5.5x increase in the 1990s. And again, as the number of transactions are increasing, and I think the numbers I've got them here, but you've seen triple-digit percentage growth over the last 3 decades. Now, in the old days where it's kind of just go through the trading blotter and just see who that was and kind of link the call, when you're looking at sort of the number of transactions going through and the requirements, technology has to step up there, because as the number of transactions start to increase, obviously the burden on reporting and understanding what's in there definitely on the increase.
The load of transactions and putting these transactions together and reporting them is significant, and it's a technological problem to solve on how you actually do that. So depending on the size of your firm and the business that you conduct, you could be having, tens to 20, 30 millions of transactions, if not more. And total events could be over 1 billion events that you're siphoning through to kind of put those records together. And so the whole kind of process there is very complicated, and to be able to then get it done in certain time periods is really challenging as well. And I think if you go back to the market structural changes that have taken place outside of volatility, so like obviously the Lehman era, the financial crisis was an interesting time because market volumes like spiked like crazy. I remember being on like an agency trading firm, we loved it because there was so much volume, and we were like, oh, this is amazing. Just because the volumes were so high. But that was volatility driven. And then after those events kind of like tailed off, the volumes receded, I think, in the following years. But now we've kind of seen like steady increase in flows, specifically in the U.S. markets. And I think it just speaks to the strength of the U.S. economy and the U.S. markets here and how resilient they are. And one of the things that we've been seeing here is just a massive inflow of business coming from outside the U.S., more so than we've seen before. A lot of money coming in from Asia and other areas into the U.S. And so the retail swing, so where it used to be all institutional, that swing is that is moving more towards retail. And I think, retail probably is like 35% of the market, if not more, today in the U.S., which is a massive shift.
Yeah, agreed. I mean, Raj, I don't know if you've got any thoughts on that. I do see we have sorry.
Yeah, I was about to ask that. What's the sort of, can we answer the questions that are coming through?
Yeah, perfect. I think I want to try to keep this as interactive. So I see AJ kind of asked a question there, so kind of more directed to you. Are we seeing a bigger shift towards TRS-based lending and TRS-based structural arbitrage?
Yes. From our, I can't really answer from a US perspective. I'll let Ralston do that. But in the European space, certainly, it's been happening for the last 5 years, and the main reason for this really is that the change in regulations of how balance sheet is treated for banks and non-banks, effectively, right? So it costs banks to trade on stock loan and repo compared to TRS purely because in a TRS, because they sell the asset off their books. This eventually has a net positive effect on reg, whether that's a LCR positive or a liquidity coverage ratio positive or net stable funding ratio positive. It's a shift that's already happening. And if you think about it, let's imagine two large banks, right? Like one's going to be long X, one's going to be long Y. If they've got a match or one is long and short, why should they go to an agency lender and borrow at 25 basis points, giving them dollar collateral or non-cash collateral? They should just swap it, right, to cover their shorts, and it's cheaper. So I think that realization has taken place in Europe in a big way. Now, obviously, in Europe, you've got the element of dividend, sort of, because there's a question there of structural arbitrage. I don't know how much the people can talk back to us. I'm going to try and ascertain what Ajay means by that. And maybe Ajay, if you can hear me, you could clarify that on point as well. But I guess you are talking about corporate action arbitrage, which and the TRS as a method is being utilized to optimize corporate actions. And the answer is very much yes. It's driven by the first factor I just mentioned. But the second factor as well is that TRS fundamentally is a dislocation of the swap and the hedge. In theoretical terms, they are not connected, even though from a balance sheet perspective, even from a management perspective, that they should be. But because of theoretical non-correlation of those two opposing transactions, makes it a lot easier to act in certain markets for structural arbitrage. So answer is yes, and correct. So you're right in your assessment.
Again, perfect. Thanks, Raj. And again, we'll go through these questions as we come up. I see Jerome's asked a question, which also it almost feels like a perfect segue into our next segment, where we're going to talk about regulatory compliance, managing liquidity across multiple jurisdictions. So one of the things I'm just going to kind of line up here, and this is and Jerome, please let us know if this kind of answers your question. And this was diversity versus generalization and the technology associated with that. So, one of the things we know, Raj, that Mirae has a very diverse offering, right? As you mentioned in your intro. So maybe just talk us through a little bit about, what does that mean for Mirae? What are the technology implications of, the overall customer experience? Because I mean, customers are becoming more advanced now. So, customers want to knock on. Do they want to knock on one door to get multiple answers, or do they want to knock on multiple doors? There is the burden of KYC, onboarding, going through all of that. So maybe just talk us through a little bit about Mirae and your business model around your wide offering and what that means from a jurisdictional perspective and the risks associated with those different jurisdictions.
Okay, so the Mirae doesn't run a branch-based structure. So basically, every entity is distinct. So it's fully held by the holding company, but like the UK entity is distinct to the US entity, for example. They aren't. The only connection they have is they have the same owner, but apart from that, they are we treat them as third parties as much as us. So what the problem with that model? Well, there's some benefits of it. Obviously, it means that people are very siloed and they focus on their own to improve their own regional presence, and therefore, in effect, improving the geographical presence across the world. But the problem with that is that they also make decisions regionally, which basically means that and we are looking to actually change that. So we have a overarching business management team now that kind of is looking to equalize the regional gaps and figuring out let's say, for example, our Hong Kong team has a fantastic risk model, a risk system, and we don't. So, can we employ that risk system to our system? Stuff like that, right? Because initially when it all started, people were just doing regional things, right? They were just building their own bits, and there wasn't a direct consistency in that. And that is a problem because quite simply put, one area can do TRS, the other one cannot. Just because the systems have been built differently. One area it has exchange memberships for Euronext, the other one has Eurex. I mean, why don't we do everything? Right? So it's just sort of piecemeal. So I think what happens is that as a company, that's when it's growing, it focuses on its core principle and kind of focuses on that, but then organically, if you don't manage the growth of that firm, it can go in various ways. And now with all honesty, we're trying to sort of do a catch up of that situation. I think it's a good thing. It essentially means that we require a underlying technological solution that solves for all the various problems being had at the various points of it. And I think that's happening now. So thankfully, the realization is very much there. The technology is the solution to this problem, but the problem is also there, and we come across it regularly, way more than we would like to, where we assume that the other part can do X because we can do it.
Correct. Yeah. So that kind of standardization of the offering. I mean, when it comes to technology, I mean, for most of our viewers here, there's generally three options, right? It's build, buy, or partner, right? When it comes to technology. Now, again, when we talk about at EXANTE, we offer access to 50 plus markets, 1.6 million instruments, and from a sort of customer experience perspective, that is a very strong offering in the marketplace. But that comes with its own technological problems, right? That you don't find one provider out there from our perspective that covers all of those. So we have multiple connections in the background, and the technology is key to keeping that kind of offering where it needs to be. And as you mentioned, we've got different operating hours on different markets. So again, keeping that technology standard is the key, right? And maybe that's a good segue over to you, Ralston, because I mean, you at Velocity, you look after the US markets, which again in itself is big enough, but you guys tend to be more specialized in what you do, right?
Yeah, I mean, but I think the story is similar. It's the build by partner. We operate a large technology organization, and so what we tend to build are the things that enable us to support and customize workflows for our clients, and then we tend to partner with strategic entities where we think that we have some unique IP that we want to introduce into the equation. That will provide us with a little bit of edge. So, for example, we might partner with someone in and around some of our trading technologies on how we access markets and what we want to do there. And then, as far as, buying stuff, I always say we buy for convenience. And so there are certain things that there's, plenty of solid vendors out there for, and we'll tend to use vendors in those scenarios to the extent that they're capable of supporting the business. As the business has evolved, for us, we've seen, tremendous growth over the last 2 years in our business, which has resulted in, us outgrowing some of our vendors. And so as a result of that, we've had to kind of double down and build out some of the things that we were using vendors for. But fortunately, like I said, we've got a very large and really talented technology team that has helped us do that. And so in the last year, we're supporting 24/7 trading. So, with the rise of Blue Ocean as a venue where we start trading for the day at 8 p.m. and we end trading for the next day at 8 p.m. And the cycle just continues every day. And so to support that type of workflow, we had to build out a pretty sophisticated stack that handles a variety of different scenarios from the different types of clients that we support around the globe. And so, I think that those are kind of like the questions that as you're running a business that you have to kind of figure out, like, what's the right allocation of resources, at the time.
I mean, it's an interesting point you raised there, because technology for the sake of technology's sake is, just because you can do something doesn't mean you should, right? This is where, firms, including ourselves at EXANTE, you do sort of proper cost benefit analysis from a customer experience perspective. We talk about, the difficulties or the sort of resistance you get in changing systems that people don't want to do. But, if it's regulatory or sort of driven from the top, those are the changes you have to make. But again, it's standardizing that data. And as things start to become more diverse and you start using different technology sets, as Raj, it creates challenges, right? Trying to standardize a lot of that stuff. And again, we made mention of the fixed protocol. It's a very loose example that we use, but standardizing a lot of those pieces meant it was really, that was the way we could move forward. And the one example I've got written on here is the USB, right? Again, it's not really technology as in the context that we're talking about it, but the standardization of the USB import on your phones and for data transfer, right? So, yeah, I know, Raj, I don't know if you just want to kind of just touch base on that as we go through some of the, you talk about the challenges. I mean, as you start to run different technology stacks across different divisions, you create problems, right? And standardizing that data is key, right?
It's massively key. It's one of the most difficult things, actually, because you've got it's essentially plumbing, right? Like, look at it from a pure plumbing perspective, right?
Infrastructure,
like
right?
You've got these pipes running. They might not be the most efficient ones, and you come up with this fancy new system of now you've somehow figured out how to connect those pipes, right? But you may have to rip the whole house, all the pipes out first, and that's challenging. It's very costly. It's hugely challenging, so much so that a lot of people choose not to go down that route. So even if, like, sometimes we look at the technology, we're like, this is better than what we have, and we would love to have it, we just cannot, because if we wanted to have it, we would have to rip out what we have and cease trading for the next 1 month and a half, and we just can't do that. So we can't afford it.
Yeah.
So
it's the question of legacy, right? So the legacy technology that's in place, you've got a new technology hot on the streets, so yeah, and it's great, but you kind of have to worry about the infrastructure. And then again, there's the whole customer experience. As people want more connectivity, service level agreements need to be put in place. Certain, I wouldn't talk about guaranteed uptimes, but there's certain commitments from providers, from clients on how, and it's a big risk, right? We understand the benefits of adopting new technology. We all do. But there's a risk associated with changing the system. There always is.
Massive risk. Diego Costa just asked a question on geopolitical landscape. I don't know whether we can look at that right now. The reason that's an important question here is because I was at BCS, which is a Russian the Russian BCS Prime Brokerage, which was the London-based FCA regulated broker dealer of BCS, which is one of the largest Russian broker dealers at the time during the Russian crisis in 2020. So it's a question on how tech technology requires to change really fast. I mean, I don't know whether people remember this, but Russia was actually banned from SWIFT messaging during that period. And I remember watching a huge effort done at BCS and across the landscape in Russia to come up with a solution. And they came up with a solution in a couple of weeks, which was insane, given how embedded SWIFT was into the system of settlements. So to your point, I think people have learned from that experience, and should have learned from that experience is the right way of putting it. Whether they did or not, I don't know, but obviously the complexity of geopolitics is changing regularly. I mean, we're watching it now. That, who knows, how deep this situation will go.
That was a really interesting time though, because I was running into it during that period of time when everything froze up and you couldn't settle trades. And so these are counterparties that we'd had for 10, 20 years, good counterparties that we know are good for these trades. And then the assets got frozen, or the SWIFT messaging got shut down and they couldn't deliver the cash or securities, and you're stuck. And so like everything kind of came to a grinding halt for like a month, I think it was. Around certain situations, which is like you just aren't expecting. It was like the event that we never thought would happen happened, right? Because you're going through your risk analysis, and you're like, oh no, these are good counterparties, we've known them forever, and it's either a DVP trade or what have you, and there is no risk. And then all of a sudden, something like that happens, and you're just kind of stuck. And you're like, oh my God.
Yeah, I think one of the things that which is really, really interesting to talk about actually is, as BCS, BCS was never sanctioned. It still isn't. It was eventually sold off, but it was never actually caught up in any of the European and US sanctions. It's a private company. But anyway, every time we tried to move money out of BCS, it went through like days and days of checks. And at the same time, you have counterparties expecting this money coming in. We're like, listen, we've sent you the money. We can't prove it because we don't have SWIFT. Okay, number one. Okay, but they have to sort of rely on us saying that we're sending them snapshots of like JP Morgan screens and Citi screens, etc. And then they're sending us default notices, basically saying that you haven't given me the money. We're like, we have given you the money. Like, it's because of. So we eventually had to, our head of compliance at that point actually write to the FCA saying that we won't default, but you're making it very difficult for us not to, because eventually someone's going to basically pull the trigger on us, because there's only so much leverage we can use across the street. It was an extremely challenging time, a great learning curve, but definitely an extremely challenging, interesting time in one's life.
I mean, I think this just shows the kind of diversity in the types of risks that are associated. I mean, we saw the sort of subprime crisis. I mean, I remember I financed my first car and just coming out of high school during the Asian debt crisis. And these were financial risks, which, us in the financial markets, we tend to better mitigation plans, better risk plans. But every now and then, it's a couple of these events. And I mean, I've kind of circled it through, on my notes. I mean, we think about the flash crash in the Dow in 2010, right? It's just kind of the beginning of algo trading and automated trading, and people say it was an older fat finger era, and yes, that happens in any market they do, but not having the correct controls. I mean, there was a crazy time where this kind of version 0.1 of this technology was just coming out, and everybody thought it was great, and all of a sudden the Dow dropped 1,000 points. Like
at that point in time, the entire market was just not prepared for electronic trading, and the amount of naked access that was out there. I think almost everybody was running almost naked access platforms, which were unfettered access to exchanges, which is a really scary concept when you think about everything that was going on. And I'm surprised that there weren't more issues. But there is, if you talk to a handful of the banks, I'm sure they'll talk about like different scary situations that they lived through during that period of time, and lessons learned, and how quickly they then, put in motion projects to put better controls in place to prohibit those types of activities, even before the flash crash, I think. But like that flash crash was like a massive awakening to the street.
I think we touched on it, where regulation drives technology adoption, but the reverse is true too, right? So advances in technology.
I was running a large execution business at the time that was inside a fintech firm, and most of the stuff that we had in place what didn't have like robust risk control checks on it. And so I remember like our biggest initiative was trying to build out the platform to do not only for our brokerage business, but for our software clients to support all of the new risk requirements that were put in place. It was a massive undertaking. I mean, I think it took us a year to build something, that was robust enough to comply. But yeah.
And I think, I don't know if you've got thoughts on this, Raj, but I mean, we look at the CrowdStrike issue that happened a few months back, right? As the world becomes more and more connected, we can have the best sort of planning and BCP and contingency plans, but as they get more and more connected and as the technology starts to come up, we are starting to identify risks that we didn't even know were there, right? So it's, trying to foresee these risks. And this is that kind of piece where technology kind of has to catch up. But a lot of the times we don't know what that next big problem is until it happens. We can kind of talk about the black swan events and stuff when they talk of, in statistics. But a lot of the times, as we become more and more interconnected and as technology starts to bind more and more, and we be able to, interact with each other quicker, get better pricing, better reporting, there's always these components that most of us, 99.9% of the world, don't even know. There's one or two components that sit in that chain that we've never even heard about. And these are the problems that regulators and sort of people really have to look at and go, where are the weak points in this chain? And, I don't want to be sort of doomsday, but there's probably going to be one or two more of these events that kind of happen. We just don't know about, right? And, then you'll find that kind of technology incident regulation, right? And that kind of continues. So now we need to do that. And then everybody needs to adopt that new technology. So, yeah, I mean, I think we look at it in a lot of the stuff that kind of happens, from a technology perspective. I think we know 99% of it, but there's still that kind of unknown piece that can happen, right?
100%. I mean, look, regulation is post fact, right? So it usually happens after to control something that has happened in the past. And there's a realization by the people who make the regulation that we should have done this, and then they do it. And it probably doesn't happen. So you're absolutely right. Like what's going to happen next is not being regulated right now, and who knows what it is. Like it's very difficult for anyone to sit here and comment what that might be. But obviously, one way for us to mitigate it, not foresee it, is to be aware of the variation of risk that we have on our books, and to somehow manage that. Technology plays a major part of that, and it's catching up. It needs to get better. It is getting better. Unfortunately, even something, a lot of this stuff is backward looking, so it's very difficult to model the future without knowing what it might be. But there are attempts being made now with AI and stuff being integrated into the risk frameworks. I think it'll be interesting, but it almost, sometimes you wonder whether it itself could be a risk factor one day.
Yeah, I mean, we cannot have a technology discussion. You cannot have a financial markets discussion. Let's be honest, you can't have any discussion these days without AI being brought into it. And again, I touched on a little bit earlier about the kind of unregulated, brand new sort of automated algo trading models and stuff that were put in. And I think I have a golf club that's AI powered, whatever that means. I mean, I kind of just
improved your game.
Well, I wouldn't go that far, but maybe the AI hasn't got there yet to my level of terribleness at golf. And I think this, I mean, it's an interesting topic, and we cannot close any technology discussion, any financial market discussion, as I mentioned, without AI. Now, I was on an AI discussion, I think last week. One of the people in EXANTE from the technology was taking us through, and the kind of futures of technology. This kind of seems like technology that we still don't really know how to do it. What the impacts of that are going to be. I mean, from our side, from EXANTE's side, we use a lot of AI based to run risk scenario analysis and just kind of do a lot of that kind of processing power at the back where you've got multiple reports and combining everything. But I mean, I just wanted to get your thoughts on the panel. What do you think on AI? I mean, we know it's going to be there. What that is still to be defined.
I think there's some. I don't know, Raj. I don't know what your view is, but I think there's a little bit of like terms that are thrown around that are a bit confusing. But I think like within the equities businesses, that I've been responsible for a period of time, we've been using machine learning for a long, long time, and which is not AI specifically, but it is, it's a form of like leveraging similar like types of technology to kind of get smarter and smarter and learn from your mistakes and then change your behavior moving forward. And so we've been doing that for a long time. I think AI, we're starting to look at how to adopt AI into the business where we think it's appropriate. And so I think like, for example, chatbots. And so we can create AI and train up an AI engine to understand everything about our systems. And so if you're an end user and you come in and ask a question, 9 out of 10 times the AI knows the answer, right? And so those are like really interesting uses. We're also starting to use AI and some of the natural language processing add-ins that AI has to get insights. And so we're starting to think about, and we're like beta testing or incubating certain ideas on our quant teams, but they're looking at, like taking in text, for example, and understanding tone of text and learning from it. And so like building up a pattern and learning, like every time this guy says this is what this means. And this is what he really means behind his words. Or even building some AI engines that listen to voice and understanding how the voice changes when they speak. And so like, if you go back to like, what was it? SACCAP, or I forget, one of the hedge funds back in the day used to have calls and they would train people to ask questions to see how people responded. Well, AI can do that way more efficiently. And so there's really some interesting applications from an investment perspective on the AI side. But I think it's some early days, but I think like from a compliance perspective, like all through the business, anywhere where you can present it to a problem and it can learn, build the applications for it.
Perfect. Raj, if you've got any views on AI, I know it's, like you say, large language models, natural language processing, all of these, it all kind of gets thrown into this AI bundle. But, I know a lot of the traders are using AI we talk about sort of large data processing and, the ability to run that. So AI is definitely picking up the slack on that. But with regards to driving liquidity, I mean, these are kind of interesting aspects. We still kind of we've got the technology, we're just trying to find the use case right now. And I think that's
right.
Where,
I think, and I think just like with any new technology, it's going to be certain everything and anything, even if it's not required in certain situations. I think we obviously know that there are some amazing benefits of AI. So I don't really want to focus on that because obviously, very simple things AI can do really well. Stuff that we initially was slower, it can make it faster. Like there are good positives of it, but one of the concerns I have, I suppose, of AI is that with anything, especially in this current environment, social media is so rampant. The overuse of AI will actually mean that the I part of it will which is or the HI, I suppose, is what we'll take a step back and sort of rely on AI. AI is only relying on what you put, what it knows, right? What it sees.
Only as good as the data set that it sits on top of, right? So at the end of the day,
I think to be honest with you, it's only as good as the question you ask it.
Yeah,
exactly.
And so I've been using, I'm like, my guys all write code in Python. And so we're using Python to do all kinds of things. I don't know Python, but I go to the AI and I say, hey, I'm really trying to figure out how to do X, Y, and Z, blah, 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 blah. And it says, oh yeah, this is how you would do it. And I said, oh, can you write me a Python script that does that? And it says, sure, here you go. And it's amazing. It took like 5 minutes. And all of a sudden I've got this Python script that does X, Y, and Z. And so like, it's a really interesting tool. I always compare it to like, and maybe I'm nerding out here, but like, have you ever watched Star Trek and you're sitting there and they're like, computer, tell me blah, 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 blah. AI to me is kind of like that. And I think like how we evolve as a culture will be how we can leverage these as tools to accelerate our path forward. And so as you've seen like accelerations in the ability to do certain things from a technology perspective, all the automation that we've seen, AI is just another way of extending how quickly the human brain can process new things and do things, right? Which I think is really cool concept.
I mean, I'm trying to sort of quote something I read recently. I may get it wrong, but basically it said that the problem with AI is that it does my music and my art, so I can do my dishes. I want it the other way around. I want
yes.
so I can do my music and my art.
Yeah, correct. Yeah,
So
it
it's
is.
like kind of like focusing on the wrong thing, I don't know. It's a very interesting concept, and I think it'll become more harnessed if used well. I'm sure, and just Ralston made a great point of like of sort of stuff like that. Python, which is a closed form solution. There's only one way of doing that thing that Ralston's asked, right? So there's no subjectivity in that question. So therefore that is perfect case use for that.
I also so I kind of got the AI bug, I don't know, a couple of months ago, and I started playing around with it, and I was like, and having been in the business for a long time and living through a variety of different technological advancements, especially as it relates to algorithmic trading and understanding some of the basic concepts of how the models are written and this and that, I started to ask the AI questions about. I said, okay, can you help me think about VWAP? And so it says, oh, sure, I can. And it gives me this response, blah, 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 blah. And it quotes all these different guys that have written these different models. And I said, oh, that's an interesting model. Can you help me pull that model out? And it says, sure. And I'm like, can you put that into a Python script so I can have that as a base level? And it says, sure. And then I said, okay, now if I want to have the ability to start thinking about price forecasting, how would I do that? And it gives me this thing. I'm like, oh, that's cool. I'd like to take this piece and that piece and formulate that into my code, my VWAP code that you've written for me. Can you do that? And it says, sure. And it adds it in. So you can sit there and talk to this thing, and it will then start to compile something. And then you can say, okay, great. Now that we have this there, I'd like to back test it versus a data set. Can you help me do that? And so it's a really interesting way, and like time to market on idea generation and things that you're thinking about. It's a really that would have taken me, if I was starting from scratch with my quant team, it would have taken months to get to a point, which took me 30 minutes. I mean, it was just an amazing kind of acceleration of things. And like I said, so like knowing the questions, and I went to my quant guys, I said, oh my God, can you believe this? And they're like, oh, I would never have known to ask it that question. So I wouldn't have gotten the same result. And so I still think that there's the human element, which is the things that you've experienced in life, and injecting that into the engine to get these different responses, I think is really interesting.
And it is, I mean, it's, there was an interesting talk around sort of robo advisory, and, when AI, kind of starts advising on financial positions, where's the value in there? And it's kind of from a regulator perspective around, regulators always want somebody to call in front of a US Senate commission when something goes wrong, right? As you start to get a lot of this black box technology, and, this was some of the questions around when AI started copywriting certain people's voices, started taking songs. Who's liable for that? Is that the person who wrote the code? And as machine learning and that starts to make a few more decisions and starts, reducing parameters of the inputs and figures out a solution, I think, we could probably spend a whole new session on AI and some of the values on that. But I mean, I think.
Did you see that article where this is where AI goes off the rails? I think there was some article about they asked the AI a bunch of questions, and they kept asking it the same question over and over and over again. And like after the seventh question, the AI gets frustrated and angry with you and starts providing sarcastic responses.
And did you guys hear about that thing where they asked ChatGPT how many R's in strawberry? There was like this whole thing. It said how many R's in strawberry. It kept saying 2, and it's like, no, there are 3. And it's like, can you spell strawberry? And it kept saying 2, and it's like a weird, like it couldn't for some reason. The 2 R's that in berry, it couldn't
pick up as just sort of saying it phonetically, right?
It was quite interesting.
I think it's a scary concept though. Like, who is responsible if the machine goes awry, right? And at the end of the day, like the brokers leveraging this, and this might be why like the brokers are hesitant in deploying some of this technology, specifically in trading, because it's just the outcome is unknown. Whereas like a machine learned outcome is something to back test it and test it, and you know what it's going to do before you actually put it in place. But yeah.
All right, perfect. Well, I think it's probably a good play. I mean, I've just finally, we've touched on AI sort of going forward, but maybe just we got 1 or 2 minutes left, and I know you've got a hard stop, Rod, so I'll ask you first. I mean, I think just kind of an open question, but like, what do you think is going to be driving technology in the future? We've mentioned AI, we've kind of mentioned regulations. I mean, do you think it's going to be more of the same of that, or do you see anything else kind of driving the decisions we make on technology going forward.
I think one of the things where I think technology can really add value, and I'd like to get Ralston's view on this as well, is to kind of look at, and I'm answering this very much as from my world, is to look at a portfolio margining which is completely asset agnostic. I think we still haven't cracked that quite yet, and I think people have given it a good bash, but it's really, people like us and similar to Ralston, I guess, are screaming out for that.
Yeah.
If we can get some closer, whether use AI or whatever, to get to that solution. But if someone can start working on that sort of solution, which gives us comfort, and we can sell that to our CROs, it gives them comfort, that'll be a game changer, right? Because clients want that, They don't want the stress of having various margin requirements. They want netting, they want risk pricing for one thing. It's this portfolio-based approach is cross asset, cross product is what's it may not be possible, by the way. I'm very well aware that it might be asking for too much, but at least coming close to it I hope would be where technology goes, because technology should only go where demand is, right?
Correct.
You don't want to solve a problem we don't have, right? So
then you're left with a technology set that doesn't have a use case, right? We've seen a lot of these startup companies with great technology offerings and very slick presentations. They just haven't found the problem for it yet, right? This is also the other downside of technology, right? Running these things in real world examples. A lot of great things. I think about the Google glasses that came out all those years ago, like 10 years ago. Great technology, no use case, right? So again, this is where the demand, and at the end of the day, it comes down to the bottom line. So you can create technology, unless it's solving the problem, people are less likely to pay money for it, right? Ralston, I'll leave you some closing notes here if you want to.
Yeah, but I would agree on the portfolio margin thing. I think a more efficient use of capital would be a fantastic thing to achieve. I think unfortunately, market regulation seems to be driving the technology agenda, and we can't seem to get a slowdown in regulatory change. That seems to be fairly consistent every 4 years. Some major shift or change is occurring at some place around the globe that then occupies the technology budgets for the next 2 to 3 years while people remediate and put in place new systems. And I guess the only positive outcome for most of the regulatory changes is that they tend to change market structure. And with the shift in market structure, it creates new opportunities. Mm-hmm. So, I think decimalization and all that stuff that took place a long time ago, there you saw the rise of ECNs. I think Reg NMS was the proliferation or fragmentation of protected venues. And so the rise of the exchanges took place. And then MiFID II, the elimination of BCNs and rise of SIs was all in the backdrop of some fairly significant regulatory changes that took place. And so as depressing as it sounds that regulations drive the agenda, I think behind the scenes, there's a lot of innovative people that look to then innovate on the back of change to provide alternative and new ways of navigating our markets, which is exciting. And so, I think we're on the cusp of a new regulatory shift here in the U.S. The SEC just passed some amendments to Reg NMS, and I think that there's mixed views on those changes. Initial thoughts of changing min tick size for a subset of names, changing the the round lot numbers for different types of stocks, and then putting fee caps in place are all major shifts in how people think about providing liquidity, accessing liquidity, how the exchanges operate, a variety of different things. And so, again, that is a major technology lift. So if you think about all of the remediations that need to take place for the systems out there to now change the rules that were put in place originally with Reg NMS as it relates to min price increments and things like that, that's a major lift. But at the same time, we're an innovative culture, and I'm sure that off the back of that, people will start to rethink how to provision liquidity, what type of liquidity will be out there. Personally, I think that the dynamic of the fee cap is going to significantly change how people think about trading and where they trade. And potentially you could see a rise, a push more towards principling solutions that exist out there.
And I think it's probably a good point to close on. And if there's any questions in the chat, now's probably a good time. And again, I think it's a great point. I think we both, all of us kind of summed it up, where it is a technology catching up with regulation catching up with technology. But in amongst all of this kind of disruption, there's good opportunities for a lot of these providers to come in and offer these solutions. And there's always a question of first early adopters versus picking up the version 1.1 as opposed to version 1.0, getting the people to test, coming first thing into the market. But I think it's a very interesting discussion, and like I said, we could probably talk about this for another hour and a half, but I know you guys are all busy. So firstly, just Raj, thanks, and apologies again for the technical issue.
No, thank you. Sorry for the delay. It was really useful event. Hopefully other people found it useful as well. I mean, the audience is.
Perfect. Thanks again. And Ralston, thank you. I know it's the day's almost starting now on the east coast of the US, so you can
get to it.
You can take the hour off at the end of the day. Just tell them it's on me. It's fine. Tell them you had an early start. But perfect. Thank you very much, and to everybody on the call, to the webinar. Thank you very much for your time. I hope you found this insightful. We try to keep it as low key as possible and not turn it into a presentation. Just sort of three professionals having a discussion. So hopefully everybody enjoyed it, and stay tuned for the next topic. Keep your eyes open on social media for the next piece we're going to discuss. So thanks to
Thank you.
our panelists.
Finally meet you, Ralston.
Very much.
Yes,
Hopefully we'll
nice
see
to
each
meet
other
you,
soon.
Yep.
Cheers, everybody.